basic frequency and severity, so we're all amongst friends here, so we can use those types of words, but the frequency and severity is increasing, and we can all debate if that's climate related or not. There's so many posts about the statistical norms of that, we won't go into all that here, but I think what's happening is if you think about perils, we're seeing frequency and severity increase in perils that we wouldn't have typically seen the frequency and severity in. So take like a hurricane as an example. We would expect and see these massive hurricanes, but the flooding and Ian and Ida are great examples of this. The offshoots of the hurricanes with the massive flooding, and if we go back before Ian and we go to Ida, the eyes are getting me. What we saw in the Northeast within, New Jersey and New York, etc. So there's that, of course, why do policyholders care about that, right? Because there is this coverage and this reparation that needs to occur for their homes and for their livelihoods and for their businesses. And, we'll get into that in a moment because I have personal stories associated with this, right? So policyholders need to care because there's an affordability associated with it. There is, the more claims we have, the higher prices are. We'll talk supply chain and things like that in a minute. So I guess the thing is it's not as infrequent as it used to be. It's not as predictable as it used to be. And the perils are becoming multifaceted. So heat, flood, damages, etc. So I'll pause there.
No, that's really good. And I think you nailed it with there's a lot of exposure from other perils, including our own man-made perils. And Jason, I think that's a really good lead-in for you who insure commercial energy risks. Energy resources are often thought about high risk. We all want, clean energy, but we really are afraid of the risk that it brings, and other types of energy resources. So why is that, and how can we think about that risk differently?
Yeah, so I think this is on, right? Yeah, so KWH, we do, as you said, commercial property, but specialized in renewable energy. And when we think about the perils, renewable energy is all throughout the U.S., right? Tends to be a little bit more rural, but still hurricane, flood, hurricane and earthquake being, I guess, the big two traditionally. In our market, it's actually hail is quite a big risk, and brush fire and wildfire is quite a big risk. And what's happening in our market today is that, given the property markets are hard to name, it used to be, I was a former banker, as David mentioned. It used to be I would just tell my clients, bring me basically an infinite amount of property insurance, and they'd show up with it. And as a banker, we're not trained in natural catastrophe perils, so we would just offload that to the insurance markets. And what's happening today is you can't buy hail cover for your solar project. You just can't buy full limits for that. So our market's kind of going through a transition where, you said, why do people care? Like, our policyholders have to wear more of the risk. They have to wear bigger deductibles. They have to wear sublimit. So like, if they blow through the sublimit, they're wearing the top end risk. And the banks are kind of freaked out that if there's not enough insurance coverage, they're going to lose their loan. So it's incredibly important, obviously, that these all have insurance on it. And we're approaching it with the lens of data as a way to support the underwriting, and we could talk more about how you can harden those types of facilities. But all of the perils are important. All of the perils theoretically could be modeled in software, but they're not really calibrated for this asset class. And it's going through, I think we're in a transition now where the policyholders, especially in commercial, have to wear more of the risk. So they're forced to get more creative and more innovative in how to mitigate it, because you can't just pay an insurance company to take it anymore.
Yeah, absolutely. I think that is a really good incentive for the policyholders, and we'll talk in a little bit about specifics that people can do in commercial and homeowners to mitigate risk. But Deepak, you look at a lot of new ventures. Where are you seeing the best investments in understanding this climate risk so we can begin to understand how to harden properties?
Yeah, absolutely. So from, I guess, starting at the baseline, so we have done a few investment in the risk selection space, that category. And I would quote some data because I think that's important. In 2020, so this year will be the second year in a row where we were going to be seeing more than 100 billion in insured losses across the world, all over the world, with US attributing to over 50% or more of that. So why is that important? I think that goes back to the severity, the frequency and the severity of the cat events that's been happening recently, and to name a few, flood and wildfire are the biggest ones there. So in that context, I think it's very important for us to start looking at some of the tools or technologies that are out there that could help mitigate some of those risks. So for example, novel data solutions that could tackle that. And I think Kevin is going to talk about at Delos, which is just tackling that, using several data sources to build these wildfire models, to build sort of the portfolio of properties that could, in the long run, could predict better wildfire losses or could offset some of those. So that's in the risk selection space. We're also interested in learning a bit more about some other areas within just climate in general. So for example, asset as a service for financing solutions. There's also, for example, in the how do you empower the risk or resilience managers to sort of not only just detect any of these events like wildfire, but also communicate as well as respond appropriately. So there's things we're interested there as well. But there's also a lot of things happening around the emissions. So if you look at the state of Connecticut that recently, I think last year, launched or there was a legislation which is essentially around that insurers in that state, like Hartford to the world, will have to start filing the emissions in their underwriting model. So that's something that it's going to at one point start catching up throughout the US. So these are some of the trends that we've been looking into.
And so, what does property hardening look like, right? I mean, how many people here? I'm going to get a little interaction from the audience here. How many people are involved in a role where you feel like property hardening and resiliency is part of it? Okay. Really good. So, we expect tough questions from you all at the end of this. So, Kevin, what does property hardening look like? You're a wildfire specialist. Dallas is a wildfire specialist. What does it look like?
That's a great question. So, if it's okay, I'm going to take a quick second and step back and take a little bit of an inventory of the market and the problems. And then we can look at exactly how that impacts policyholders, how that impacts homeowners, and what wildfire hardening looks like for an individual home. So if we look across the industry, we have a situation where there's not enough insurance for a lot of large property classes. We look at how there's reinsurance itself is hardening, and we're in a situation where insurance companies are struggling to find enough cover for a bunch of different perils. We talk about, and I appreciate you saying that Dallas Insurance is the best investment you've ever made. I totally agree.
I just wanted to wait for you to.
Yeah, sort of, I just wanted to interpret it, use different language for the same thing that you said.
Thunder here.
But looking at, like you're saying.
I think I should have sat between you two.
Yeah, maybe. You can see the connection. We were talking about flood. You're talking about wildfire. You're talking about a lot of these different perils, hail. The reality of what's happened over the last 10, 20 years is climate change. And we talk about this as climate perils now, finally, right? Just looking back, 8 out of the 10 largest wildfires in California's history has happened in the last 5 years. 9 out of the 10 largest hurricanes in America's history has happened in the last 20 years. And if Ian is telling us anything, and Ida, it's only going to continue to get worse. Yeah, and Ivan and Igor are coming up soon. So, 20, oh my gosh, maybe though. Catastrophes are getting way worse than they were before. And what that has done has caused a lot of different industries and a lot of different asset classes, normal ways of working, risk transfer. It has impacted that to the point where it no longer works. All of that feeds itself down to consumers. So now homeowners, commercial property owners are sitting there saying, okay, I'm in a situation where I may not have enough insurance. And even if I did, my home, my property is directly at risk of burning down, flooding, getting hit by hail. So what do I need to do? The reality on the ground is people are scared. We talk to people all the time that call us and say, hey, I definitely need a policy, but also can you tell me how to protect my home? Can you help me figure out what it is exactly? I see a lot of things on the news, but it seems just general. What do I need to do? And luckily we have people in the audience that are actually creating companies to help accomplish that. But that in itself is an example of everything needs to be thought of a little bit differently. The fact that there's not enough reinsurance cover means that the entire way this industry works needs to take a second and think about things completely differently. Because climate is no longer something that you can grab a model, fit it into the rest of your perils. It's something that needs specialists. It needs smart technology. It needs a different way of working with consumers. And once we're able to create a completely segmented arena that is climate affected risks, climate affected perils, from the reinsurer, from the retro reinsurer. Eventually there's going to be civil government that's putting up high level cover for reinsurance companies, and FEMA's kind of doing that. All the way through to the homeowner that has a very understandable, easy to use user experience of somebody saying, do these 3 things, and if you have time and money, do these 2 extra things, and then you'll actually be okay. Once we get to that ecosystem created around climate, then we'll be able to have a significantly higher level of success, both economically and just on the human impact side.
Call Kevin's personal cell phone number if you want to give it to your policyholders on how to mitigate wildfire risk. But does anyone have a response to that or a thought on that? Oh,
Sorry.
Yeah, I mean, a couple of thoughts to that. I think that that the capacity hardening is for sure. I think that we are seeing some creativity in the capacity market, like with ILS structures and other structures, right? I will. Cyber is also hardening as well, and we're hopefully going to see anybody do ILS in here. Any ILS experts in here? No. Ooh, we're missing. Oh, there we go. I think we're going to see some ILS coming in. And anyway, my point is, I think that it's interesting because the point I wanted to make here is that we're seeing a lot of spot solutions to a very holistic problem. So I love the fact that you use my least favorite overused word, which is ecosystem, but it's pointed in the sense of we need to come together and stop the fragmented point solution. So I do agree with you that it needs to be holistic. I'm only joking because everyone hashtag ecosystem. I'll use it in my post. No, I joke and I don't joke. Seriously, we need to build, and for those of you investing, VCs are like the worst at rewarding point solutions because it's focused, it's go to market, get your channel, get your ARR. And what we need is integrated holistic solutions. So that would be the point I would like to amplify that you made, which I really do love that line of thinking. We need to be integrated, we need to be holistic. So it starts from the capacity, the financing, all the way down to making something simple and actionable by the point of the business owner or the homeowner. So.
We're all ears. So
No, so the point that you made that resonated with me was the specialist point. I'm going to say specialist on the risk, but also specialist on the asset class. So, I'm not an insurance guy by trade. I started in renewable energy. I entered insurance. My background's finance, and my kind of crude view of the world is that the banks have figured out some of this stuff a little bit earlier than insurance companies. Maybe just they're more direct to the client. And in banking, what we see in renewable energy is you have specialist groups. There's Wells Fargo has a team that knows and lives and breathes renewable energy. And you kind of make your way now back into an insurance carrier, and it's maybe an energy person that knows oil and gas, or maybe a property person that's trying to figure it out. And what happens is the loss history in our segment is very bad because these people are not, there's a lot of nuance in what leads to performance of these facilities. And they're just not specialists in it. And I think, to me, when I look at kind of where I think it's going, I think you're going to have specialists like cyber. I think used to be D&O underwriters that then became cyber specialist underwriters. And I think in renewables, it's kind of property or energy writers that are going to be renewable energy specialists. I think you're going to see that in more segments where there's just kind of specialty risks that you need a specialist view on. Because otherwise the loss history is not very good.
I absolutely love that point, and to sort of underline what you're saying, if you look at cyber, it was originally under, just a general standard business insurance, general liability, D&O. And as soon as it got a little more complicated, because cyber is a new peril, a new risk, I think it was very easy for the insurance industry to very quickly say, Allstate, State Farm, the guys that are currently in their back scanning all their paper documents, they're probably not the right people to figure this out. They looked at it and basically said, the constant war between hackers and security personnel is changing constantly. It's ever more complex. It's an arms race that will be iterating continually faster. And because of that, you shouldn't have a generalist carrier or generalist risk underwriter trying to understand that risk. And so what's happened is it's a great place for MGAs to pop up. Your cowbell, right?
CSA.
I thought Avanta invested in Cowbell.
Yes.
Yeah. You guys are in Cowbell.
Yes.
So Cowbell, Coalition, at Bay, all set up to solve exactly that gap, right? Where they can take something that's incredibly complex, use a density of data in a way that's they understand the actual technical side of that data and use it to become more accurate. And climate is exactly the same thing. That's going to head in the direction of specialists that understand that. Right, we have a world where insurance companies have been reusing some modelers that do one thing to try to do another thing, while the world's best, academics are sitting on the sidelines, not helping people, helping insurance companies actually understand those risks.
So we need a holistic approach, industry approach, but it starts with specialists. So let's take our own advice and get really specialized here, right? And talk about property resilience and hardening, and you guys have all a viewpoint from that. So we'll start with Deepak. Deepak, you've looked at a lot of IoT sensors. Everyone has said IoT is changing the landscape for the 10th year in a row. What's your view?
Yeah, I think I'll start at, there's a lot of different types of sensors across different properties level as well as so there's a lot of sensors. So price sensitivity becomes a big thing, but I think I'll go back to sort of what matters or what's important from our vantage point. So, for example, in areas like first notice of loss, claim support, or even fraud, I think there's a lot of impact there. And when you think about how it could, so for example, when you're looking about the claims, how can you get the risk assessment data from all these different connected devices that could essentially help bid the claims or stop the claims or minimize that whole process, which ultimately would help result in reduction for policy or premiums of the policyholders, and alert your first responders or the insurers. So on that note, we have made an investment in a company called Rapid SOS, which essentially takes all the connected devices and alerts to the 911 call centers. So for example, a smart home, if you're in a home, if you have the smart home sensors, it can alert in case of any wildfire and things like that. So I think there's a lot, especially if you look at the market report for this year, the investments have been down, but I think there's been a lot of investments happening. Take property aside, in connected homes, or connected vehicles. Manufacturing has been down, but I think what really becomes important is how can all those connected devices come to one centralized, essentially become one sort of one-stop shop and become centralized, take all the data. So I think that becomes very important because then you can relay it a lot of different areas and get that information. So, so that's kind of it's interesting. So several different devices there.
So we're getting a little bit on time here, so I'm just gonna ask each of you, starting with Jason here, like, what's the one thing that will drive value in property hardening?
Well, I'm in a very specialist asset class.
Being specialist is key here.
Yeah, being in California, the things that drive the two biggest losses in renewable, at least in solar, are brush fires. Not to say wildfires, we don't build this in a forest, but brush fires and hail. And we're seeing innovation in both of those. I'll say being in California, like the number one thing is cutting the grass. It sounds kind of silly. Solar, I guess this is like my last comment. Solar is like really good at squeezing every cost out of the system, and I think the challenge in hardening is it costs money. And we're finally seeing like justification for that because of insurance, but I'll say mowing grass, which can burn
And Lisa?
down inside.
Okay, so one thing, okay, so it's interesting, right? So again, I'm gonna go back to this holistic approach, right? And so the thing that I think that we see is breaking down these traditional verticals that we had in functions in insurance companies, like underwriting, like claims, like loss prevention, fraud, and what we're moving to, and I'll kind of key off something you were saying is, the data and the ingestion of monitoring is becoming dynamic. And we have these old traditional things that are static. All of our processes have traditionally been static in a world that is now dynamic. We're consuming information, whether it's from sensors, whether it's from satellites, whether it's from new, I'll call it observed models, right? Models that actually take observed real-time data in, notifications. We can tell people what to do when they're doing it. So I think we have to pull together a dynamic ingestion and a dynamic interaction model with the consumer. And that would go from everything from product design all the way to prevention. Like, what can a consumer do? Not just mow the grass, but what can they do? Like, mow the grass, you didn't mow the grass, can we send somebody over to mow the grass? Something's happening, and we deal with this in flood a lot too. But then I'll take it one step further. My biggest thing that I kind of think is gonna be the Hail Mary of all this is that I have a derivatives CFO finance background, so I'm going to kind of come in on the finance side a little bit, is we've got to connect this to the supply chain. So we if we think of frequency and severity, we're not going to prevent the events from happening. So we've got to harden the properties, we've got to prevent as much as possible, and we've got to drive costs down, and I don't think it's from making claims more efficient or faster or better. I think it's by actually reducing the cost of repair at a level that puts the policyholder whole. Right? So I think if we tap into all this amazing streaming of data we have, and we pre-purchase, I'm giving you guys like Lisa's secret sauce, right? To run Black Ops. Secret sauce is if we pre-purchase in the derivative market supply and resources, like supply chain, we get into the supply chain, and we pre-purchase and consume those so that it's not being up to 40, 60, 80% after a disaster occurs. I think that's my big thing.
Black Ops, Lisa. And then Kevin?
That's excellent. I think that will make absolutely tremendous difference. So first of all, right, as I was mentioning, in terms of the holistic ecosystem, we are working on not only, we provide coverage right now for homes in wildfire areas in California. Dallas Insurance, getDallas.com, stop advertising immediately. But we also are providing sort of a holistic risk assessment, right? Where somebody can download our app and understand, what is their evacuation route, what is their risk today, what can they do, what is the most effective way to harden their home, if it's mowing the grass, and it really does depend on asset class. So I do think that's a solution, but to actually answer the direct prompt. Ember mesh screens for homes is the most effective thing for that asset class. So Ember mesh screens, they're super cheap. Get them and put them on your air intakes.
On that note, that's it. Thank you guys.
All right, thanks to all. So a social commentator once said, in an election run-up between Clinton and Bush Sr., it's the economy, stupid. And I think Lisa made the point, it's the supply chain, stupid. So I think it's really important for us to understand our supply chains, understand where the cost is coming to ultimately make the repairs. And I think it's really a good lead-in for our next presenter, which is Tyler Jones. He is going to be talking about lowering attorney involvement using AI, and if you think about it, that's one of the key drivers in this whole supply chain here. So Tyler is the Chief Customer and Marketing Officer at Claire Analytics. He's a seasoned executive with 2 decades of experience in insurance and banking, and prior to Clara, he was executive director at Kaiser.
All right. Thank you, David. It is so wonderful to be here on the best coast talking about InsurTech. How many times have we had to fly to New York to have these conversations? So wonderful to be here in California. Thank you for hosting us. Thank you for having Clara be a part of this event. So today, like David said, we're going to be talking about how to avoid attorney involvement using AI. First off, before we go, I just want to introduce you a little bit about Clara. Clara is a small, not small, we are a rising claims AI organization. Rising. Yes, we are growing very, very quickly because the industry has woken to the idea that AI is something that they need to manage their loss costs. We focus mainly on workers' comp and commercial auto. This is our bread and butter. We've been doing this since 2017. We've had models working, and we've been sucking up all this claims data over the last 6-7 years. And we built one of the largest contributory databases of claims in the United States. The reason why we did this is because we want to attack problems like attorney involvement. We want to eliminate loss costs associated with medical care that's not needed, and we really want to get injured workers back to work faster. And that was really what Clara was founded on. So, attorney involvement, is it a real problem? Emphatically, yes, it is a problem in the insurance industry. It's been growing over time. There's this thing called social inflation, and no, social inflation is not an excuse for claims managers to give when their claims go out of control. It is a real phenomenon measured by many organizations. Recently, there was a study on trucking accidents. Trucking accidents where there has been losses of about $1 million. Those settlements have grown by more than 1,000% over the last 10 years. So the average settlement was $2.3 million. Now it's $22.3 million. I don't know where you guys live, but inflation is not that bad in California. Should not be growing at 1,000%. It's a real problem. This has cost the insurance industry over $20 billion over that same time period in increased payouts. That costs all of us. It doesn't matter. That gets passed back on to policyholders in form of price increases. Society as a whole is paying a cost over this. So how can we solve this problem? How can we address attorney involvement in claims? Well, we know that adjusters are the ones at the front lines of these claims. The problem is they're overworked. There's too much data. There's this data avalanche coming in, medical bills, new claims coming in on a daily basis. And it's really hard to manage all of that information. Not only is there too much information, but there's a skilled labor shortage. This is an aging workforce. And as these seasoned adjusters leave the organization, that knowledge leaves that organization. And you've got these junior adjusters coming in. Well, those guys are going to be, that's what attorneys love. They love these junior adjusters. They really can take advantage of it. So how do we solve this problem? What's our objective? Well, we really need to solve this problem by becoming a data-influenced claims organization. Carriers, self-insured organizations, TPAs, all can benefit from becoming a data-informed organization. The targeted outcomes are going to be reduced claim duration, reduced medical and indemnity expenses, and reduced settlements involved with the claims. So how do we get there? It's really easy to look at what's happened in the consumer market when it comes to augmented intelligence and AI. You know, I grew up, I lived in California for many years. I don't know if you guys ever had a Thomas guide. Everyone's had one of those in the back of their car, looking up addresses, figuring out how to go from point A to point B. Thankfully, Garmin came around and we all got these little navigation devices. They're pretty dumb, right? You had to like download new maps, and you know, they get outdated. And then the folks down the street here at Google, eventually purchased Waze. And why was Waze so great? Waze was so great because it was all based off of contributory data. Every driver on the street now was contributing data to Waze, telling how fast they could go, where the cops were. We are all marking these accidents on the road, and it made everyone's lives better. Clara does the same thing when it comes to AI. We have been taking in these claims so that we can understand the historical performance of attorneys, understand the historical performance of medical providers, and really provide augmented intelligence to carriers, self-insured, and TPAs so that they can make the better decision, keep that claim on the optimal path, just like Waze keeps us going on the right path to get us to where we want to go faster. So what is augmented intelligence in claims? We like to think of it as it's knowing which claim to look at and which every day and which ones you don't. It's predicting attorney involvement and avoiding them. It's many things that can drive lower loss costs and lower attorney savings. So how do we get there? We know there's a lot of opportunity to become data driven, but I think we, at Claire, we have the hypothesis that it's really better to become data informed. Get rid of those simple rote tasks that and allow people to focus on things that matter. So this is a model that we do for our customers in our litigation product. We predict at first notice of loss all the way through the life of the claim. As that data is coming in and new information is known about the accident, what's happened, we can predict attorney involvement with a high rate of accuracy. In this case, you're seeing they've got a couple claims that have really high attorney involvement. There's some that are already involved, and then there's some that are medium. Well, and then there's low attorney involvement prediction. You can forget about those, right? I mean, you can let those go and move on. You can see, you should be looking at your adjusters and assigning based off of attorney involvement and looking to see, not overloading your junior adjusters with high propensity of attorney involvement and giving your senior adjusters more of those cases. So, you guys have probably heard a lot about third-party litigation funding. Wall Street and hedge funds, they understand there's some money to be made in this type of litigation. A lot of investment is going in there, and the plaintiff attorneys are partnering with these hedge funds. They're very smart individuals. They're seeing the value of the data, and they're able to target the types of claims that can benefit them the most. Well, it's time for us to play attorney Moneyball. So what Clara does is we take the historical performance of both defense and plaintiff attorneys, and we can tell you how well they have performed with like claims. In this case, this attorney has an overall score of a B. His cost is fairly low. He does not do well with temporary disability, does great with permanent disability, and his settlement score is really high. So it's really good to be able to set the right defense panel, but even better, how does that defense panel perform against the plaintiff? We do head-to-head matchups so that we can be prepared. We give our carriers the defense to really go up and get the best settlement possible. One way you can actually benefit from attorney involvement or from augmented intelligence is really looking at your adjuster caseload. Now this is based off severity. So at first notice of loss, all the way through the life of the claim, we identify what that severity level is and what we predict that. You give your your junior adjusters those low severity claims that can do high volume, just get them out the door. It's a lot of straight through processing. And then you allow some of your senior folks to have the more higher severity claims. Another way to predict and really avoid attorney involvement is to get the right medical providers in place. There is a high correlation of medical providers and certain medical providers and attorney involvement. It's like they have their best friend down the street and they can refer, and they do. And so one thing that we do, and we help our carriers, is to identify who those medical providers are, what their propensity is to have litigation involved in their clinical cases, and we alert them in real time when we see that happening and we see that they've assigned a provider on this case that does that or that has that propensity. We alert the adjuster. This drives significant savings in this industry for workers' comp, commercial auto, any of the casualty claims. What augmented intelligence does, it allows you to focus on what's important today and what is not important. So every day we triage, we understand where that claim is and where it needs to, where it's going, and we alert on that value. The last thing I want to show you here is you can really avoid an early involvement or attorney involvement by looking at your low cost claims or your low severity claims. In this case, we have a low severity claim it's probably sitting in a medical only bucket. The adjuster is probably just letting it pass through. But in this case, we have a prediction that there's a very high likelihood of indemnity. So this is going to go to a lost time claim. It's going to become a little more severe, and getting in front of this, getting in and engaging with the injured worker, engaging with the claimant, will allow you to smooth over the process and eventually and potentially avoid attorney involvement. So you know, with AI, it gets a bad rap because everyone thinks you're going to take my job's going to be gone. That's not something that we don't believe in, this dystopian future where AI takes over and your job no longer exists. We believe in a future where the AI is there augmenting your intelligence, helping you, just like Waze helps me get to the airport after this a lot faster. And it's going to allow you to avoid lost costs and really drive expense reduction. In this case, the claim complexity was very, very low, but it was predicted to go from higher in severity from medical only to indemnity. And this is a type of claim that's just sleeping. It's underneath everything right now, and it's ready and it's about to pounce. So you don't get rid of your workforce, you get rid of these types of claims and you get in front of them, and that's going to drive a significant cost savings, and it's going to make your employees a lot happier because they're working on things that are meaningful rather than the day-to-day task in a claims organization. So that's what Clara does. We believe that you truly can, and we can prove out that you can lower your attorney involvement by using this type of augmented intelligence. And we've got a lot of great customers out there, some of the largest carriers in the nation right now for workers' comp and commercial auto using this. And so if you'd like to learn more, please come by, talk to some of my colleagues who are here today. We're local here in Santa Clara, just a few minutes away, and we're very excited to participate with this type of engagement with all the InsurTechs here in San Francisco. Thank you, David, for having us.
All right, thanks, Tyler. So now you have it, the small but growing organization that's going to help you fight against the attorney virus with data. So we're going to take a 10-minute break, and then we'll come back for our final panel. So try and get back to your seats around 6:40.